It's a triple greatest bubble of all time times three in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my. If you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about a foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. If it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. She says, well, we don't really need a bond market, US bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. They say when inflation happens, raise taxes. By the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. If you ask the typical member of Congress to define modern monetary theory, they'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, Acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior, let's go back to COVID, as we talked about the debt to GDP ratio. So Trump put through a $2 trillion COVID relief package. And that was when, the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. What the Fed does is nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone. He did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what we get recently was the just under $1 trillion Green New Deal, I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says it doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the US is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the US will be in fiscal distress. If we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning, but it had started. I mean, in some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, well, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Third quarter was a lot stronger, 2.6%. But when you dissect that, what you see is that was almost 100% driven by net exports. When was the last time the United States had positive GDP driven by net exports? Probably 1959. I mean, that's typically a drag on growth, and we've been running trade deficits forever. That meant that people were still buying U.S. goods, but the U.S., we were not buying as much from other people. That's indicative of a slowdown. Consumption was weak, private investment was weak, inventories were weak. Those are the real drivers of the economy, and they were all weak. So, okay, net exports, that's not sustainable. So I would look for a recession, a more severe recession to begin in the fourth quarter. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector, and I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. So you pretty much wait until the recession has already started, and you can, all right, I got to lay some people off. So it's not a leading indicator, it's a lagging indicator. So the Fed is behind the curve. There's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So
Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts. 1929, everyone's like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down the S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. The Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on, credit losses start going up, and then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real, it's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video. Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So yeah, I do, that is my view, but it's shared by a number of other analysts. 1929, everyone's like, yeah, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932, started in October 1929, so not quite 3 years. But that fell 82%, and that happened. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. I better, if I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007. Just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video.
What do you think is a rational allocation right now for somebody who's at first and foremost trying not to get destroyed this year?
Yeah, and to be clear, I don't give personal financial advice, but at a macro level, I'm happy to talk about
Absolutely. None of this is personal financial advice. Definitely talk with an advisor, and I'm going to make that plug at the end here too.
Portfolio might look like. The first thing you say, diversification, the math and the science behind diversification and why it's a good strategy is very clear. There's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think the climate alarmists, I think the Green New Deal, I call it the Green New Scam. This is a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug of cash, absolutely, maybe as much as 30%. I like treasury notes. 10-year treasury notes, but, seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later because of everything we discussed, which is, a recession and interest rates will follow. They're a lagging indicator, but that'll happen. Gold, I always recommend 10% slice.
Hey, Jim, real quick, before we move on from bonds there. So I've talked to a number of analysts and investors, on this program recently who have echoed what you just said there about bonds. And, there are three really good reasons to hold them right now. One is just safety, right? This is a time to prioritize safety. Two, they're paying a lot more than they used to pay. So you're getting paid to sit in safety, which is nice. But then they have that option value, right? Where if the Fed does pivot and rates come down, yields come down, the actual underlying price of the bond would go up. Right. And so a number of these guys have said, the bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while. And relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously basic bond math, interest rates come down, the price of the bond goes up. They're just inverted. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher, as the DV01 is higher when the rates are lower. Again, it's all counterintuitive.
But it's sort of like a Richter scale. Each new increment is a much higher magnitude.
The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain.
Okay, great. Thanks. Sorry to interrupt, but I just thought that was a really important point to underscore.
Yeah, I agree with the analysts who are saying that. Absolutely.
Okay, great. So on to gold, you were saying 10%ish is
10%, but based on what we were talking about, I would get silver dollars, American silver eagles. A monster box, bit of jargon. Monster box comes from the U.S. Mint. It's treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American silver eagles. That's a lot. They'll feed your family for probably a year, and they run, it's a market price, but be around $10,000-$12,000 for a monster box. But to me, it's like battery and flashlights. Just have one, stick it in a safe place.
All right, great. And I'm curious, do you have any particular thoughts on silver versus gold right now in your 2023 outlook?
Yeah, I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver's a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter-ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries.
Right. So think of the gold more sort of the store of value, and silver more as the currency.
Yeah, but the quarter ounce, maybe 10 of them gets you a new car or something. So
Yeah, exactly. Yeah, for bigger purchases.
Right.
Yeah. Okay, great. So that's gold. I know in the past you've said, hey, real estate, private equity, farmland, et cetera. Those are all things to consider as well.
Yeah, I think income producing real estate. I wouldn't get into commercial real estate, residential. The prices are, home prices are coming down a little more in some markets than others. But if it's income producing and it's solid and it's in a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know that there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland, but income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes.
All right, great. I got one last topic I want to talk about with you. Before I do, anything else just sort of on actually, let me ask this. So we talked there about sort of diversification, largely with the eye towards sort of making it through what's coming here. Are there any areas that you potentially think are like, hey, given the events that we see coming, yes, while they're a little scary, there's some opportunity maybe to really, if you have some speculative capital, this could be a place that you think could pop really well?
Yeah, I mean, I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But there's some some good deals in the mining sector. I like well, that would be one. I mean, we haven't really talked about the important things going on, but we'll maybe do that in another interview. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1 worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider, something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So So, it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learned it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing we're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired a guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold. The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
In the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how the cost push inflation tips into a recession and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is a cure for. It's coming. I mean, the recession is coming, and Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. The dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from I think it's at 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control.
The renowned economist Jim Rickards continued her speech as follows. I, in the statement from Powell, indicated he didn't express that. Their focus is on the core PCE, the Personal Consumption Expenditure Price Index, core, meaning excluding food and energy, and everyone's like, why would you exclude food and energy? Once again, I'm not here to argue about it. That's their approach. They aim to achieve a 2% core PCE annually. Powell didn't mention that we're going to increase rates until core PCE is 2%. He didn't say that. What he stated was that we'll raise rates until it has a constraining effect on inflation, and inflation will naturally decrease because rates will be sufficiently high to prompt that, at which point we, the Federal Reserve, will pause. Then you ask, well, when will you lower rates? He was like, the pause could last a year. So you're talking. TW. Let go of this Fed policy change nonsense. You're talking about 2024 before they reduce rates. It's similar to what I recall from Vietnam, the old saying, we had to devastate the village to preserve it. We have to damage the economy to rescue it. This is the most recent in a long series of Federal Reserve missteps since 1913. It seems to be their specialty, but that's what they're doing. And on top of all that, there's an impending global liquidity crisis, a worldwide financial crisis that differs from a recession. It's a financial panic, and recessions are distinct events. They can occur independently. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can coincide. It appears they might be coinciding again. This is evident in inverted yield curves. Major dealers are competing in auctions for treasury bills. The Fed will provide you with treasury bills with a single phone call. All you have to do is contact the Fed and conduct a reverse repo. They'll provide you with some treasury bills. However, banks are bidding in auctions for treasury bills that yield a maturity lower than what the Fed will provide with a phone call. Why would they do that? The explanation is that the Fed bills cannot be rehypothecated. They cannot be used as collateral. However, the auctioned bills can. This indicates there's a collateral shortage. This implies reducing balance sheets, financial distress. And we also observe it not only in the Treasury yield curve, which is inverted from 6 months to 10 years at present, but also in the Eurodollar futures curve, which is even more concerning. It's not unprecedented, but it is rare, and it's not a good sign. Nevertheless, the Fed persists in raising rates despite this extremely unfavorable data. So, I anticipate a significant recession in the US, and the global outlook is fairly grim. Moreover, there's the possibility of a global financial liquidity crisis worse than 2008. If all I've said is accurate, which I believe it is, or I wouldn't be stating it, they could, at the very least, take a break now or even reduce rates. But if we're on the brink of a global liquidity crisis, as indicated by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with a yield at maturity below what the Fed will provide with a phone call. All these developments are taking place. That's hard data, and it's a very, very concerning sign. Less evident in 2008, incidentally, prior to the Lehman Brothers collapse. So, with the economy naturally entering a recession, along with the brewing global liquidity crisis, why on earth is the Fed raising rates at all? That's unsustainable. So I foresee a more severe recession. That's one aspect, combined with Fed tightening, interest rate increases, balance sheet reductions, and so on. That's one whole dimension, and I wouldn't place much weight on a low unemployment rate. It disregards the labor force participation rate, which is abysmal. You know, it's around 62% compared to 70% in the year 2000. However, unemployment is a lagging indicator. Unemployment rises after a recession begins. Employers are very reluctant to lay off employees. You have to pay severance. Recruiting and rehiring them and providing training is costly. Employers typically wait until the recession has already commenced, and they say, "Oh, well, I have to lay off some people." So it's not a leading indicator, it's a lagging one.
Don't forget to like our video and subscribe for our channel.
The Fed will not be able to get interest rates to 5% without causing a recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic, and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen. And it's not clear which, but it's going to be one or the other. They're going to keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. but the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either, because the Fed doesn't drill for oil, they don't build pipelines, and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.